what is the market thinking in regards to the RBA decision? Indeed, has the expectation played a role in today's trading, Tim?
Well, looking at the market today, it has improved throughout the session. We have come off the lows of the day. The market down now around 0.4% or so, I believe. It is a pretty defensive day on the market, though. You look at the sectors which are outperforming. It's really within those staples, the utilities, the healthcare sectors, which are all outperforming the broader market, while the heavyweight sectors such as the materials, mining, energy, financials are the big weights on the market. In particular, the diversified financials having a bit of a rough day following that Macquarie profit outlook. Macquarie shares down over 3%. If you have a look at some of those mid-cap and small-cap fund managers like Platinum Asset Management or Henderson Group, they're all down off 2 or 3% today. So the focus certainly is on the RBA today. The Aussie dollar actually has trended slowly higher throughout the morning session. This is on expectations that the RBA will hold rates. We've also seen some house prices rise, and also the trade balance narrow as well, which has helped the Aussie dollar move higher. But the ASX 200 now recording the second day of losses if we were to close in negative territory today. So the question will be, is this the start of a correction? If it is, I would probably look at a few levels on the market. 45.70 would be one. That was where we saw some consolidation at the beginning of the year, so this could turn into some support there. Or if we look at the past correction in the market was around 5%, so I would be surprised to see the correction sort of move past on the ASX the 46.70 level.
Look, we're talking about, I suppose, technical levels to the downside. One stock certainly not helping at the moment, Cochlear. It's getting hammered on market after missing expectation. Just taking a look at their shares, down 6.5%.
Yeah, really smashed today. I mean, this is a great company, quality company. It's a great Australian story, but the shares today off over 6%. Net profit came in around $77 million. It missed expectations of around 81. And this was despite selling a record number of its implants through those 6 months to December. But if we have a look at the share price over the past couple of years, it has bounced back very strongly after it fell around 40% when it announced it was recalling one of its products. But I think when it did fall 40%, there was a lot of concern in the market surrounding the damage towards its reputation. But considering the share price performance since then, it seems that those concerns were well overdone. And in terms of this stock, which consistently trades at quite a high premium in the market, buying into Cochlear when it did fall to around $45 now looks like a very good entry point back then in 2011, back in October, because the stock has now rallied around 78% from those $45 lows. Now, speaking of Cochlear moving into the future, I mean, this is a quality company. I mean, it will continue to demand a market premium, so it will be a difficult stock to buy into, I suppose. And even though the stock has fallen over 6% today, still trading around $75, which is in terms of a PE, price to earnings ratio, is still a very high price to earnings ratio.
Is it overvalued, Tim? Is it? I mean, you take a look at the 12-month chart on Cochlear, and look, it doesn't come much more impressive. A lot of people saying now, you know what? Maybe a correction is good. Maybe a bit of a pause, a pullback is good because it's run too hot.
Well, I think if there would be a correction or pullback, that would be supported. I think that would be a good entry price if we did see a correction. Because if you look at the company, I mean, it's a quality defensive type company, but it certainly still has growth options as well. So there's no reason why the share price can't continue higher into the future. You look at its global position, it's still holding 65 to 70% of the market share within its industry, and it's continuing to grow its global reach as well, expanding further into different companies. If we have a look at the results, I mean, revenues continue to hold up very well for the company despite the Eurozone crisis, despite the concerns around the globe. So if there was a correction in Cochlear's share price, I would suggest this would be a good entry price to the stock.
It's despite the Aussie dollar as well. I mean, they have a lot of their sales overseas, a lot of their production overseas. A company that's done very well. Moving on, another company that's done well today, at least on the market, Transurban. I'm looking at their shares before, up around 1.5%, of course, coming out with their first half results.
Yeah, well, Transurban, probably not the most exciting stock on the Australian market, but putting in a good performance today, up around 1.5%. The headline net profit figure actually fell from the previous corresponding period, but there was actually some positives. If you look deeper into the results, you saw that revenues were up around 3.8%. If you look at earnings before interest, taxes, depreciation, etc., EBITDA, that was actually higher as well. So that came in slightly above what the market was expecting. While their dividend, they pay an attractive dividend, the yield's around 5%. They also increased their interim dividend to 15.5 cents, which is up 1 cent, so a positive there. If we have a look at their performance in terms of segments, they fully own the Melbourne City Link Road, and that accounts for around half of the company's revenue. So to see a 5.8% rise in the toll revenue from that road was a very good result. While this company does have very stable earnings and dividends as well, it's seen a pretty steady share price performance, up around 12 or 13% over the year. But the outlook for this company really is dependent on traffic volumes, and that in turn is very dependent on the broader Australian economy and also employment levels within the Australian economy. And with traffic growth only expected to average around 2 to 3% over the longer term, I think Transurban is never going to be one of those stocks to really excite the market or really break out in terms of investments. It's a very defensive type stock, but given its assets, it does trade a little bit of a premium as well, so you do pay for the quality of its assets at the same time. So it does trade on a fairly high PE ratio, relatively speaking, but the result today was a good one for the company.